How are you, folks? Enzo DiCostanzo podcast. And today we're going to be talking about the Standard & Poor's 500 index with an eye towards for the St. Peter's crew. We're going to be talking about that with an eye towards the final exam, which is going to be in May for both the graduate course and the undergraduate. So let's give you guys a background. We got some sobering news today from Bartolomeo that we're expecting a profits recession, I suppose. A reduction in corporate profits generally leads to a reduction in the Standard & Poor's 500 valuation. And today we want to talk about a piece of that. We want to talk about what the Standard & Poor's index, the Standard & Poor's 500 stock index, what that is and what an index is. And we'll look up some numbers. So we'll do a lot of that right now. Okay. Do our screen share. We're frozen for a second here. I apologize. There we go. I apologize for that. It's time for a new operating system. I know that. It's time for a new operating system. So we have a couple sets of definitions that we're going to talk about. So hopefully everybody can hear me still. Here we go. We'll do, yeah, folks, I apologize. It took a couple seconds there to catch our breath, apparently. We'll do the, we have a couple definitions of what the index is here. We have some stock prices we're going to look at. We have a graph. We're going to make a graph. We're going to look up the Federal Reserve, the St. Louis Federal Reserve data. We'll look that up. Okay, so we'll do a bunch of that. Okay, we're here with this. If I'm cut off or not cut off, I don't know. If you really how much you really care about seeing me, so we'll see how this turns out. But if I'm cut off or not cut off, we'll see if does that do anything if it's cut like that off. But you guys, there I am right there. Okay, so I'm here. Well, so let's take a look. And so here, the inspiration for this is the following. These are the notes for the final exam. And they mentioned financial markets a lot in this. Monetary policy is mentioned a lot. Employment, certainly inflation is talked about very much. And we have the listings here of some of the topics, what a term premium is, what the staff economic, when I say the staff is the Federal Reserve staff outlook, committee policy action, and then a bunch of definitions, what a central bank is, what the Treasury is, what the Federal Reserve is, what a bank deposit is, and then actually some new developments that was we went back in time, went back a decade or actually 2 decades ago with Bill Gates, mid 2000s and the mid 2010s, and looked at his money manager and how he makes decisions on in his business, what to put resources behind. But now we have something that's current, that the bank out in California that failed. Okay, so we have something current that we're going to look at. These are some developments on financial markets. And anytime you see through, and it's sort of volatility, and we'll look at our measure of volatility. I'm not going to turn it into an index, but certainly if you have enough math ability, you can turn these series of percentage changes or point changes in these stock indices into another index, if you wish. But it's an index of an index. I mean, we're really, I'd rather just look at the percentages here. But anytime you see financial markets, it talks about the behavior of the Standard & Poor's 500 index. So we're going to go over a couple sets of notes today. We're going to make a graph, and then we have a press release as to how stocks are included down here in the Standard and Poor's 500. I didn't go into market capitalization, but we'll just by osmosis we'll sort of talk about that. But also, um, the last time I did this lecture, we had the Standard and Poor's numbers here and what they looked like. We probably went to Yahoo or something like that. So what we can do is here. Let's before we even just here. Here's what I'll do. I'll block these out, and we'll block these out, and we'll get some and actually all of this. Actually, I'm going to leave these here. Well, here's what I'm going to do. I'm going to cover them in gray just to remind. So we're going to look at share price. We're going to look at shares outstanding and some of the dimensions of these numbers. I mean, these are numbers in the billions and trillions. This is billions. This is trillions. The market capitalization for Apple and Microsoft is measured in trillions of dollars, which is bigger than the economic output of most nations outside of about 10. Okay, so those are countries. Microsoft's a country. Apple's a country. Amazon's a country. Even Tesla. Okay, and the Nvidia, someone I forget somewhere, someone was talking about. I had I heard a quick conversation, I guess at the water cooler today regarding diversity and all this other stuff about the components of a portfolio. And I think someone was saying if you invested in Nvidia, Microsoft, and Apple 20 years ago, you'd have beat the Standard and Poor's 500 by a lot, type of a thing. It was that kind of a conversation. These are the top 10 holdings of the Standard and Poor's 500. I think JP Morgan dropped out, but we'll still study it since it's a major bank. But I think it got replaced with a healthcare company. But we'll get to that. So here, let's cut to the chase here with all these things we're speaking about here. Let's look at this. The Standard and Poor's 500, and there was actually a guy called Vincent Poor, I think his name was, and there was a guy, there was a standard statistics company, believe it or not, and they merged around the time I think Value Line came into being. So a lot of this, so Standard and Poor's 500, Value Line, which I worked for, was an independent research firm. A lot of this sort of I don't say formalization, but sort of trying to get our hands around the information of what a stock exchange is, all came around, the research and the companies all came around around the same time. Let's see, are I'm looking for the names of the guys if they're named here. I know I highlighted it somewhere. That's it, and we'll talk about what an index is. Well, and economists love indices. 30 down. Here it is. So this is sort of how it got invented in 19th century. So 19th century means the 1800s. A financial analyst, Henry Poor. I said Vincent Poor. I think Vincent Poor is a baseball pitcher. Sorry, Henry Poor. Sorry. And it compiled an annual book that Warren Buffett used to like to read, I think. Listing publicly held railroad companies. The publication merged with the Standard Statistics Company in 1941, and the 500 is the number of stocks that comprise the index. I don't know if it's 500 today, but it's certainly in the neighborhood of that. It's a little more secretive. Entomology is the study of the origin of words. So it was a statistics company, a financial that should tell you about majors. What's a good thing to major in, and we'll get to the definition of an index in a bit. But it's a market capitalization weighted index of 500 leading publicly traded companies in the United States. It's not exactly the top 500 companies. And how do you measure? Is it by employees, revenue, the star power of the executives, what political party they donate to? How do you determine the 500? Is it earnings? Is it stock price? Is it market? Is it value? Is it market capitalization? Is it plus? Do we add the debt, subtract the debt? How much cash is on the balance sheet? Right? There's so many ways, right? So many accounting terms to measure there. But the market cap, because there's other criteria, the indexes include. So the S&P 500 index is regarded as one of the best gauges of American equities, the behavior of such, the performance by extension of the stock market as a whole. And again, part01 was on a couple days ago, and they were talking about the potential for a stock crash and what's going to drive that stock crash. And I saw coming was earnings. Okay, and we'll see if how right we are. But I would have made that the same prediction, because if you're gonna start laying people off, demand maybe won't be as strong, people aren't earning as much, then people can't spend, the consumer can't spend, the consumer can't behave in a manner that sort of strengthens and grows commercial activity, economic activity in this country. Okay, so if you're all of a sudden going to have you're looking at higher unemployment, more unemployed people, less employed persons. It's the result of that is not going to be higher earnings. It's just not. And certainly with higher interest rates, you've got more of the available resources of companies paying off debt as opposed to going to the bottom line. So that more dollars are siphoned off at the interest expense line and don't make it down to the earnings line. If they don't make it down if the earnings lines are reduced from what they previously were, the value of the company reduces, and hence you could have a 10, 20, 10, 15, 20, 30%, 25%, amount 30, but maybe 10, 15, 20, 25% reduction in the value of these indices. And let's look at the behavior. We're also going to graph the Standard & Poor's 500 we're going to graph it from the, and you guys just bear with me here. But that was a video I was watching. So S&P 500, St. Louis Fed, the data. Again, folks, I apologize for how slow the systems. I don't know what's going on. I should have restarted it before I started doing this session with you guys. But I'm back to Zoom a bit. So the last couple videos are Zoom videos. So maybe we're taking a little bit more resources than this computer can stomach. A dozen years into it's 12 years old, right? A dozen years into its life. All I did was type in S&P 500 St. Louis Fed. That's all I typed in. There it is. There's the series, the Standard & Poor's 500, and you could go 5 years back, or let's go to the beginning of 2018. Let's do something like that. So the most current. Okay, we do have Friday's number in there. So that it shows about 5 years. And again, we've elevated from the Trump years. How well Trump was doing. Well, again, you had the big dip because of COVID. Okay, and then you had a couple of but still you had valuations were generally pretty good because the government basically printed money to keep everything going to the point of maybe overheating. This is an overheating economy. That's what I'm telling you. That's what that is. So here you would do one for 1801, like the 1st of January, whatever it could be. There you go. So you have that data. We could even download it now. We set this. So this is January 1st, 2018, and we'll look at the behavior. And certainly here, just looking at the graph supplied by the St. Louis Federal Reserve, all of this up and down. You've had a lot more volatility in 2022. So if you take the end compared to the volatility here, the ups and downs aren't as much. I hear you had a couple big ones, but certainly during the Trump years, you had very smooth progressions, very, and if you go back further, 2017, I think they'd be even smoother, but certainly here it's far choppier. Okay, that's what that's when you look at, again, a lot of work to sort of illustrate what the Fed is talking about here. It says measures of implied volatility across financial markets declined somewhat from the elevated levels observed in October. They're talking about November. Okay, so but in other words, though, you want to study the volatility, even if it's for a month or October or whatever it might be. But and we'll show you how to do that without going bananas, making indices and an index of an index. And what you generally do is you hit the download, and we'll do this. We'll hit the download button, and we'll get back to that. Okay, but we'll get back to that. And this is just some summary stuff here. It features 500 leading publicly traded companies with a primary emphasis on market capitalization. That's the way it's constructed. When I was at NJIT, we looked at how I think we computed the Dow Jones divisor, or made an attempt at it because it's proprietary. Made an attempt at what that was and computed the actual index. The Dow Jones was just a bunch of prices added up of the 10 or 12 biggest companies that existed about 100 years ago, or whatever it was. So that's how it's important to know how these things start. So the S&P is a float weighted index, and we have a very specific mathematical definition of that. That's what's out there being traded. The market capitalizations of the companies in the index are just by the number of shares available for public trading. Yeah. Okay, because the depth and diversity of the S&P is widely considered one of the best gauges of the large U.S. market, large U.S. stocks, and even the entire equities market. You can't directly invest in the S&P 500 because it's an index, but you can invest in one of the many funds that use it as a benchmark tracking. So whatever that means. However, Vanguard or Bank of America, you say, hey, I want to invest in the S&P 500 index. However they do that, are they buying the shares in equal proportions in terms of what's in the index or whatever it might be? But what you're trying to say is you want your money to behave if the S&P 500 behaves, and the broker, the pension fund manager's got to accommodate you with that. There's some formulas here. The company market capitalization divided by the total of all market capitalizations, the company weight, so the weighting. So again, it would be nice to sit there and do this for 500 companies, but we may not have the data. You need a Bloomberg terminal and things of that nature to sort of maybe hit some of these. But you need the shares outstanding and you need the stock price. And then, but to do 500 in a class would be a lot. But it's a capitalization weighted index, which gives higher percentages allocation comes with the large. So in other words, if you're Apple and JP Morgan, you're impacting that index and the behavior of that index a lot more than a company that doesn't have as large of and that should make logical sense to all of us. Determine the weight begins with adding up the total market capitalization for the index, adding together the market capitalization of every company in the index. To review, the market cap of companies calculated by taking the current stock price and multiplying it by the outstanding shares. Okay. Fortunately, the total cap for SP 500 as well as of individual companies are published frequently on financial websites, saving investors. Wow. But again, we're in school, so we want to understand how to do this. Okay. We'd like to understand this. Okay. So you take the current stock price and multiply it by the company's, and we'll actually, so what we'll do, we're going to back out the shares outstanding, the stock price we can find in the market capitalization. So we're going to back out the stock price, but one way or another, it's one equation with three variables, and we're just going to try to figure out, take a variable that we don't know what that is, look up the other two, and then back out the third one. Again, financial websites have this frequently on there. The weighting of the company index is calculated by taking the company's market cap dividing by the total market capitalization of the index. All right, so you're looking at the impact of an Apple or the impact of a JP Morgan or whatever it might be. I don't know if the capitalization is summed on like the Yahoo Finance or something. Well, let's take a look at that. Let's see, S&P 500 total capital. Let's see if we can find this somewhere. I want to find this from a reputable. It says 33 trillion. Okay, but I don't want to use. I want to use it from a good source. Not just slick charts. I don't know if that's one I'd really like to take a look at. But they seem to be one of the few publishers of this. I saw the St. Louis Fed further down that list, so let's see what happens here. Again, folks, I apologize for the slow response. I don't know what's going on here, but the slow response of all this. Yeah, this is just the index again. Okay. Again, this is the behavior of it's not it's not the 33 trillion. It's the behavior of all of this. Yeah, this is just the index. It's not, I don't, is it giving you the capitalization here or the previous close? Yeah, it's not giving us, we could use, we here we have the Dow Jones here. And then we're going to sit here and try to look for some historical numbers or whatever it might be. We'll look up JP Morgan or something like that. And then it gives some news just to key events are shown, market watch, target, if it's higher. Okay. And this is a 1 year behavior of this with a couple, yeah, some events that sort of make these things. I learned, we love math, right? I learned long ago that it's the news that hits you. That's the stuff that really sort of moves what's going on. So Let's see, total capitalization. So at least we somewhere we have this number. I don't know. I've never used something called slick charts, but okay, we can take a look at it. And now that we know, now that we have some idea, what this number is, we could do a bunch of divisions. Uh, okay, as of today. Okay, hopefully this is accurate and correct. Yeah, they sum the market capitalization of every company, which would be tough for us to do, but it says about 32 or whatever it might be. So we can, and again, can I, can I alter the dates on these things? So we're sort of trapped a bit here in terms of, well, historical returns. Um, yeah, these and 22, a big down year, an up year, up. Yeah, three pretty good up years. Even 2020 was a 18%. A lot of good years under Obama. They're pretty much all pretty positive up to 2018, which was a Trump year. Um, Now it says we can download the returns. Okay, but yeah, component performance. So again, I don't know. I don't have a lot of, I always hate to just use these websites to just sort of come out of nowhere like this. But the capitalization here is that. Then it says the 500 S&P 500 companies. Let's take a look at that. Okay, components by weight, percentages, 6%, Apple is 6%. Do we have all 500? Maybe. We may have all 500. Okay. So we do we do know. All right, good enough. So Slick Charts told us something today. Yeah, 503. I knew News Corp, different class of shares. Okay. Well, let's see. What are some of these other numbers? The weights there, the price. It's not giving you the shares. It's here. It's giving you the weighting and the price is what it, and and it's like I said. So yeah, see, we have United. We could do the top 10. We could change some of these if we wish to. But what we'll do is we can find the stock prices of these and back out the capitalizations is really what we can do. Uh, we have that one. Okay, so with this, okay, we do have market. We do have 2.35 trillion. We have that, and we have previous close, the current close. Okay, we can back out shares outstanding from this if you wish. And this is just in the day. You could go for the 5 years of this. But use Apple, it's done nothing but grow from $50 a share to triple that. So you triple your money in just a couple of years if you looked at this. Okay. But we're gonna get back to that. We're gonna Okay, like I said, so there's some computations to, and again, computation is always a part of what I'm talking about. So yeah, talking about the weighting and the market capitalization, total cap of the index, fine. And then it says it's a member of a global family of 1,200 indices. There's 1,200, not 1,200 companies, 1,200 specific indices, including the S&P 500, mid cap 400, the small cap 600, the small cap whatever, the mid cap 400, the S&P 500, and these combine to cover 90% of all capitalization. In an index known as the S&P Composite 1500. Okay, so if you add up all three of these, it's most of what the Standard & Poor's organization covers as the 1,500 most important companies in America. It uses free floating shares and to calculate the market cap, meaning the shares that the public can trade. And this S&P 500 adjusts each company's market capitalization to compensate for new shares issued or company mergers. The value of the index is calculated by totaling adjusted market caps of each company and dividing the results by divisor. And the divisor is proprietary information. Like I said, when I was at NJT, we tried to back that out a bit and see what we could get from that. Okay, we'll get back to that. We'll get back to that. We can calculate the weight in the index by which can provide the investor with valuable information. If the stock rises or falls, what's going to be the impact on the index? So if you have a company with 10% weighting, it has a greater impact than on the index than a company with 2% weighting. All right, it's one of the most widely quoted American indices because it represents the largest publicly traded corporations in the U.S. and the S&P 500 focused on the U.S. market large cap sector and also floated weighting index, a type of capitalization weighting, meaning the company market caps are adjusted fine by the number. Okay, we've repeated that a couple different times. It was rebalanced. It says most recently December 3rd, where who left and who left and came in, but I think you could. It's probably there's probably other adjustments that took place. So in other words, the mid cap constituents, Solar Edge Technology, Signature Bank, Fact Set Research were all bumped from the S&P 500, replacing the constituents Leggett, Haynes Brand, and the Western Union, all of which moved to the mid cap. So these were bumped up. Okay, these no right. So Solar Edge, FactSet, and Signature Bank entered the S&P 500, and then Haynes Brand, Western Union, and Leggett and Platt were demoted to the minor leagues, I suppose, at the S&P mid cap. And there's probably a progression of that. Then they were going to compare the Dow Jones, the S&P. Obviously, there's more companies in the S&P 500 by a lot. Okay, but the Dow Jones has arguably the most important ones. Is it, the S&P is a little more representative of U.S. equities because it comprises more stocks across all sectors. Okay, and it uses market cap weighting method, and a higher percentage of allocation comes with large market caps, while the Dow Jones is price weighted, gives companies the higher stock price, higher index weighting. So, and again, the thinking of the time was just to add up the prices, but then the capitalization became a more important version of all this. The market cap weighted structure tends to be more common than the price. So yeah, it's more common than the way the Dow Jones was computed, however many, 100 plus years ago when that sort of was invented. NASDAQ is global electronic marketplace for trading securities. There's several equity markets indices that include stocks traded on NASDAQ. Note that given a stock including the S&P 500 index may also be one or more of the various NASDAQ indices. So yeah, you might have you're going to have some repeats, which is never bad, but it's important to know that, and to know that and what you're looking at here. There's the NASDAQ 100, which is 100 of the largest, most actively traded common equities listed on the NASDAQ. It's the Association of Securities Dealers, whatever it is. It's something like that. You guys can look that up. It didn't stick in my head what it is. And quotes, I think National Association of Securities Dealers and quotes, something like that. So, which the media simply often refers to as the NASDAQ, which includes more than 2,500 common stocks. All right, the NASDAQ Global Equity Index, which includes international stocks, and the Philadelphia Semiconductor Index, and some of those. Okay. This one has the definitions in there. This was from a year ago, and folks, I apologize. It's taking its breath to catch up to you. There it is. We talked about the Schiller Index at the time. Dow Divisor, the Dow Jones, market capitalization, what price weighting is. We had a lot of these. The index, National Association of Securities Dealers, automated quotations. So I apologize for stumbling over that. It's my fault. I wanted to get that just right. Okay. And then the Russell, Charlie Munger talked about the Russell. Obviously, the Russell's got a very large index. All right, these are both market cap weighted indices unless otherwise stated. Okay, there's differences between these families of indices. A committee picks the standard. I met one of the people involved in that committee. Picks Standard & Poor's 500 constituents. The Russell uses a formula, and there's no name overlap in style. So there's no growth versus value. Okay, in the S&P, well, the Russell includes the same company in both value and growth style. So yeah, how these things are constructed, the companies have, I'm sure they have their lists of reasons why they do what they do, and I'm sure there's plenty of reasons to stand out. The Vanguard tracks price and yield performances of the S&P 500 index by investing in total net assets of the stocks comprising the index and holding each component with approximately the same weight as the S&P 500 index. And this way, the fund barely deviates from which it's designed to mimic. So yeah, that's how Vanguard will mimic this. Okay, it's an index. It can't be traded directly. Those investors must invest in a mutual fund or exchange that tracks the index. Okay, so as the Vanguard way, so they look at what the breakdown is and try to break down your account to look like the S&P 500 is what they're basically saying. There's limitations when the index becomes overvalued, and the higher than the fundamentals warrant. If a stock has a heavy weighting in the index while being overvalued, the stock can inflate the index or the price of the index. And a company's rising market cap isn't necessarily indicative of the company's fundamentals as much as it reflects the stock's increase in value relative to shares outstanding. To the demands of the market, basically, as well, equal weighted indexes have become increasingly popular, where even companies' price movements have an equal impact on the index. Okay, so again, you could have an irrational market price at some point, and it can distort what that index, the what's the published value at the end of the day. And yeah, this is an example of Apple's weighting in this, so we can just take a quick look. Now, we're not going to necessarily, we're just going to talk about this. Apple at the time that this was authored had 16 billion basic common shares. And their October 2021 annual filing had a stock price. They went right to the annual filing with this. So this thing was October. You can look on the front page and get some sense of the common shares. It's published on the front page of the annual reports. And they had a stock price of 173. Okay, shares issued, outstanding. The market cap was about 2 trillion. And that 2 trillion came from this number times 173 or thereabouts. I said 16.32, but the guys who made these notes they obviously these numbers should be the same, and they're not. So right away I could say, hey, and so the trillion is used as the numerator in the index, and the market cap is the denominator, which is about 40 trillion. At the time we looked it up, it was about 33, which is the sum of market caps for all the stocks in the index, and the Apple's weighting in the index was approximately 7%. So you would take that 2.8 divided by the 40, and you could probably say equals to, we're just going to do a direct computation here, 40.15. Yeah, you have your 7%. Okay, as these, so this was just a direct a hard-coded computation. And the larger market weight of a company, the more impact each 1% change in the stock price will have on the index. Note the S&P does not currently provide the total list of on the website outside of the. So I don't know. They said this, but then we just found them. So maybe the S&P doesn't provide them, but somebody provides them somewhere. Okay, whatever this is, Slick Charts provides them, and hopefully Slick Charts are accurate. I don't even know. I've never even heard of this, but okay. For the moment, we're working with this. Okay, so yeah, this was just sort of in words. Obviously, these need to, the 16.71, the 16.32, that should be the same number. It's not, but okay, what are you going to do? All right, and then the stock price as of whatever February 15th was what it was. An index is a method to track the performance of a group of assets in a standardized way. It's measures the performance of a basket of securities indicated to replicate a certain area of the market. These could be a broad-based index that captures the entire market, such as the S&P 500 or the Dow Jones Industrial Average. Okay. Or more specialized, such as indices that track particular industry or segment. Fine. It measures price performance of basket securities using standardized metrics and methodology. The index and the financial markets are often used as benchmarks to evaluate the investment performance against passive indices. Become popular, so they're low-cost ways to replicate their return. So maybe there's the buying is done once and that's it for the year or whatever it might be, and you do how you do, kind of an attitude that certainly could be. Um, Economists love these things. An index, it measures other financial economic data such as interest rates, inflation, manufacturing output. They serve as a benchmark against which to evaluate the performance of portfolio of returns. A popular investment strategy is indexing, is trying to replicate the index by a passive manner rather than trying to outperform it. Okay. So yeah, so like I said, you guys have all these notes on Blackboard. An index is an indicator or a measure of something. In finance, it typically refers to a statistical measure of a change in the securities market. And it's saying we created an index based on the changes, but I'm just going to do it as a percentage, and you're going to look at that, and we could graph those percentages and see how volatile the behavior of the market is. You cannot invest directly in an index. The S&P index and the Bloomberg Aggregate Bond Index are common benchmarks for the stock and bond markets. In reference to mortgages, it refers to a benchmark interest rate created by a third party. Okay. Each index related to the stock and bond market has its own calculation methodology. Relative change of index is more important than the actual numerical. Yeah, so we care about the percentage change, not so much what that index number is. The FTSE 100 index is was that the English? Maybe the UK. It's 7. Yeah. So with that, so if an index, so if a 100 index is 6,670, it's almost 7 times the base level. To assess how the index has changed from the previous day, investors must look at the amount of the index has fallen and express as a percentage. We'll do that. These benchmarks are used. The benchmarks are used to measure the performance of mutual funds, exchange traded funds, those kinds of things. Mutual funds compare their returns to the S&P 500 a lot of the time to give investors a sense of how much or less the managers are earning on their money. Index is a form of passive fund management instead of a portfolio manager where they're really trying to time the market. That's active stock picking. It's market timing. There's no other way to say that. You're paying someone to do that. Choosing securities to invest and strategize when buying and selling them. The fund manager builds a portfolio where the holdings mirror the securities in a particular index. The idea is that by mimicking the portfolio of the index, profile of the index, the stock market as a whole, or a broad segment of it, the fund will match the performance as well. Since you cannot invest directly in the index funds are created to track the performance. These funds incorporate securities that closely mimic those found in an index, thereby allowing an investor to bet on the performance for a fee. The Vanguard S&P ETF, which mirrors the S&P 500 or something to that effect. So we talked about a couple classes ago. I'm trying to sort through when it was, but we did speak about ETFs and did a little bit of graphing of ETFs and things of that nature. Again, a mutual fund or an ETF or fund sponsors attempt to create portfolios mirroring the components of a certain index and allows investors to buy a security likely to rise or fall and tandem with the stock market as a whole with the segment of the market. Okay. It's repeating the best owned index, S&P 500, commonly used as a benchmark for the stock market. 80% of the total stocks traded in the United States. The Dow Jones is well known, but it's only 30 of them in there. But 30 most prominent, most important companies, and we have the NASDAQ, and we have the Wilshire, and we have some of the Morgan Stanley, the Bloomberg Bond Fund. And again, like mutual funds, index annuities are tied to the trading index, and rather than a fund sponsor try to put together an investment portfolio likely to closely mimic the. So we're repeating ourselves here now. These securities feature a rate of return that follows a particular index, but have caps on the returns they provide. I didn't know about that. So if an investor buys an annuity indexed to the Dow Jones that has a cap of 10%, the rate of return will be 0 and 10, depending on the annual change in the indexes. And I didn't know that there was a cap on annuities. And what is that? If there's more gains, who gets that? Must be the manager, right? Adjust for mortgages, deal with interest rates, adjust over the life of the loan. The adjustable interest rate is determined by adding a margin to an index. One of the most popular indices in which mortgages are based are the London Interbank Office Rate. But I think that there's going to be something else now. Not the LIBOR is being replaced. If a mortgage index to LIBOR has a margin of 2%, the LIBOR is 3%. The interest on the loan is 5%. So yeah, these things are used in mortgages. So indices are a big concept in economics. And this is a little bit more with the S&P 500. So let's bounce back to the sort of the discussion up here. And actually what's down here, these are some of the, and I found the most recent one that I could find. Um, the criteria for being a member of the S&P 500 S&P Composite 1500 Index. 13 billion or more in market capitalization. For the mid cap, it's 3.6 billion to 13. For the small cap, it's just under a billion to over 3.5 billion. And some of the other criteria, um, unadjusted company market capitalization. So this is for new capitalizations. That's the previous ones. The new ones are bumped up to some of these numbers. This is 3.7 now, and this is 14, and this is 14.6 as opposed to 3.1. So again, so the ranges of capitalization that you need to be a small cap, mid cap, or S&P 500, that's for new entries. Now, if you're already in there, are you going to fall out for some reason? And I'm sure there's decisions that are made like that. So yeah, so it's a minimum threshold to be added, but the ranges are reviewed, a couple times a year and updated to assure consistency with market conditions. And a company meeting the unadjusted company market capitalization criteria must have a security level float adjusted market capitalization that's at least 50% of the respective indices unadjusted company level minimum market capitalization threshold. The criteria is not for continued membership, but it's for new membership. If a index constituent violates a criteria, the index is the constituent's not necessarily removed until the ongoing conditions maybe warrant some kind of a change in that. And they're saying that, I guess, on the S&P, the index methodology, just visit the S&P 500. Now it says S&P, I guess they merged, right? Maybe they merged now, these indices, I guess, I don't know. But you can visit that website and probably spend a lot of time learning a lot of things right there. That's for sure. It's a large, S&P Dow Jones indices are a large global resource for essential index-based concepts, data research, home to iconic financial market indicators. Okay, and there's a whole, other bunch of marketing stuff here. So here, what I wanted to look at is, let's do this. Let's see how we're doing from the start of the year to today. Well, to 310. Let's do that. So let's look for the S&P 500 value 1-1, and then yeah, we can look 1-1, and then the rest of the way. There should be historic. Actually, the reason I stopped using, at least I have trouble finding it, the historical numbers. So let's do a reason to use Yahoo Finance, right? Yahoo Finance. Sorry if it's a little hung up. Sorry about that, folks. We'll it'll spit it out eventually. So it's Saturday night. I usually do these videos like 1 o'clock in the afternoon, but Saturday night, I'm sure there's a lot of people online, so it's slowing everything down here. So So yeah, so what we're waiting for here. Yeah, so this we don't need anymore. We're gonna study, or we're going to indicate what the S&P 500 was in January, what it was Friday, and then and it's not the 1 month change anymore. So this is like the 3 month change, and then we'll look at the average behavior changes for the S&P 500 and the Nasdaq and all that stuff. Something got stuck here a little bit, but folks, I apologies for the delay here. Sorry about that. There we go. There we go. You hate that, right? You hate that. So yeah, so like I said, for whatever Yahoo, yeah, see, it's got the historical data. You could just click right there on the historical, and you could see we could just pick these off because it just there's so few of them. Yeah, you could just pick these off. So you're gonna do the close here for the 10th will be 3918.32. Whoops. It's okay. That's the 9th. This is 3861.59. That's the 10th. That's this one. And we'll look at the first here. Whoops. Right here. Or whatever, the third or something. So this is 30, 3824 right there. Right, 3824.14 and 3861.59. Okay. So you have so the 3 month change would be the so these are it's not going to be that much of a change, but if we I think if we measured it like when it was it's a percent, about 1%. It's about a 1% change. uh it was as high as 4,000, right? Well, actually this was in February. We were at 41,179. All right, so if we just come here, whoops, 41,179. It'd be about you had a 10% increase, right? And then now we've dipped back. So we're really it's lost 10% of its advances. It's lost 10% of its appreciation in about 2 months. Really, it's about 2 months, about 2.5 months. It's about a 3 month, but yeah, let's without going bananas. So, but we're percent higher. We're percent higher. We looked at treasury yields. Let's look at the Nasdaq is next. Historical. So this thing closed 11,138.89. And then ten three eight six. was right there, and you can just say Control R. So here, the Nasdaq being, I don't say a little more volatile, but you have about a 7% change in that compared to a 1% change, and also it was higher. It was about 11. Right? What was it? 11. It was 12. Right? Yeah. It was in February. It was 12,000. Yeah. So again, let's look at if this was 12,000. Yeah, but so they're all losing about 10. About the majority of their gains. They seem to be giving back a hell of a lot right now. The Dow Jones. So what do you have with this one? The Dow Jones is closing at 31,909.64. And this is about 33,136. 33,136.37. Okay. And this is again. All right, so this is actually down. Okay, so this was, yeah, what was this? This was 30, yeah, 33. And now we're here. Yeah, we're down to 31. So this is already showing up. And this was as high as maybe 34. That right, 34. So if this thing was 34, 1, 2, 3, you had a little bit of a gain. Okay, but this is where they actually are. So the Dow Jones is in negative territory. The Nasdaq is still up a bit, but gave back a lot. And then what you would do is you could take the average of all three of these. It's a meager 1.5%. If you just do the numerical average, it's 8 minus 4 divided by 3. What the average change would be. Okay, so that's an exercise you can work on. And all of these we would have to get those numbers and make these computations. And also you have, now again, the physics and chemistry people out there might have a little bit more better sense of this. You got to be aware and capable of and we have all the symbols there, so we could do, Yahoo Finance is a little bit easier to use. So for some reason it closed Friday at 148. There's after hours trade. We'll take this number, 148.50. That's just US dollars per share. The capitalization is 235 trillion. Okay, again, with trillion, that's nine. Not just nine. 12 zeros. Billion. The Bill Gates thing was nine zeros, but the capitalization there was 12. So we'll take the date here and we'll move the date up to the 10th, right, of March. Right, that's the date. And we're using some of these numbers. Obviously, if here you have 9 zeros, you have 12. You're compensating somehow. So the capitalization divided by the share price, or the shares outstanding, and then you multiply the numerator by, you have the share price there. We divided by the price, and we have shares outstanding with this thing. So you got to compensate by 1,000. So it's this formula, or these two multiplied to get that. That's that formula. So what do? You divided this thing by price. Yeah, why are we multiplying by the 1,000? I think we should be dividing by that, right? Oh no, because what you want to do is this is trillions. Well, let's see. Do we have shares outstanding here? I should have went back and checked all the shares outstanding, but we'll check the latest Apple annual report, and we'll check that number. Yeah, no, I want this. Yeah, I wanted this in billions. Yeah, this is in billions. So yeah, that's why we multiplied. Yeah. So you're gonna take this number, and it's gonna, yeah, it's instead of 2.84 trillion, it's gonna be 2,840 billion. And you're gonna convert the shares to those numbers. And here with the Apple one, we'll check. I'm not gonna check every single one of them, but let's go Apple annual report. Yeah, and we always like to see a PDF of these things. So that's the best one to look at. Apple's 148.50 a share. So you can see it's down from a couple years from last year, 140.50. Okay. There it is. And this came out October 22. You'll usually have and it talks about some of the yeah, some of the, that's weird that some of the debt numbers up there, but okay, some of the debentures are up there. Oh, that's weird. Um, here it is. It's the number here. So 100,000. So 15.9 billion. And yeah, so about 19. Yeah, these are in billions here. This is 19 billion, 100,000 billion. Yeah. So this is 19 billion. Yeah, these are billions. Okay, so the capitalization was what for Apple? 235. So it's down a bit, 2.35. Yeah. So 15.8 was the computation. Like I said, capitalization equals share price divided by shares outstanding or multiplied. So you're multiplying this and this to get market capitalization. So you've divided capitalization in trillions, but like I said, the way we computed it, we multiplied by 1,000 to make it billions. So it's really 2,350 billion dollars divided by $150 or so, and it gave me 15 billion shares, right? And again, if you look at the 15.8, and if you look at the front of the Apple sheet here, yeah, 15.9. Okay, so some were bought back, and there were movements of some of the shares. So yeah, so 100,000, yeah, 15.9 billion. Okay, and like I said, you could check, and you guys. I mean, I know how to. You guys should go through everything and check that. I'm going to leave the numbers up there so we can sort of compare to where we were. But we're gonna come back to this. Okay, but I see a Tesla, Microsoft. We're going to look at them all, and we're going to do the computations in the same way. Now, I left the last one here. This is sort of the toughest one, but it says, if you had to use a single financial barometer to indicate the strength of the economy, what would it be? Even though the Dow Jones is a well-known one and the most quoted stock index in the world, it's selective and it can be misleading, and only has 30 stocks. We've seen that about 3 different times now. And the Dow Jones represented the economy as a whole, and there's several other indices. And the S&P 500 is the big one. It's the de facto numerical indicator of the U.S. economy. And the S&P 500 gets a second billing, even in the financial media, and little recognition elsewhere, even though it's vitally important. It's an equity index, 500 largest companies. So we've repeated ourselves a couple of times. Traded on either the NASDAQ, the New York Stock Exchange, or Chicago. It's calculated by adding each of the company's float adjusted market capitalizations. In order to be included, the company must meet certain criteria. Yeah, we said 13 here, but it's not 13 anymore. It's whatever it is. It's yeah, let's change this. 14.6. as of March 2022, right? 14.6. As of March. So again, you're always updating, right? You're always updating what's going on here. Always keep that in mind. March. Yeah, these are my notes. I'm updating my own notes here. 14.6. What is that? Okay. And set it someplace else here too. 14.6. Right, at least 13, but now it's 14.6. I might say it's someplace else. Yeah, majority of the shares are in public hands, publicly traded company for at least a year. And again, you could purchase an index fund that tracks that exchange traded fund or something like that. I think we said this before. The entomology, what Standard & Poor's is, it was two people or a company of persons. Henry Poor was a financial analyst, and the statistics company merged in the 40s, and the 500 number of stocks that comprise the index. That's where that terminology came from. And we all know that it's not 500, it's 503 or 4. We looked it up on whatever that is, Slick Charts or something, whatever that is. And it says like Popes and Oscar winners. The components are selected by a committee. And it says like the College of Cardinals and the Academy of Motion Pictures, Arts and Sciences, the SP committee operates within specific criteria to qualify. The index must have the following: market capitalization of a certain size, the value of its market capitalization traded annually is got to be a certain size, at least 250,000 shares, trade each of the previous 6 months. Most of the shares in public hands, had its initial public offering at least a year ago, positive some of the previous 4 quarters of earnings, as well as the most recent quarter. And the minimum market cap for a company to be included, not to maintain membership, but to include it, is about 14.5 billion in terms of market capitalization. So, the different exchanges have lots of companies that are listed. And the first criteria, reduces the size to a couple thousand. And then some other benchmarks, reduces the number listed even further to get to the 500 or so that we care about. Okay. You're not just eating up prices. We've said that before. It's a float adjusted market capitalization, which again, it's the share price times the number of shares. It's what's the perceived market value. Okay. Float adjusted means counting all the shares are available to the public. Held by it excludes those by management, government, other companies. There's hundreds of these publicly traded companies that keep most of the shares. A lot of them keep it. Value Line was like that. 90% of it was of the shares available. 90% of the shares of that company were held by the owner. Stocks removed. It's dynamic. And it's a subsidiary. Now I guess there's an S&P Dow Jones. I guess that merger happened, whatever it happened. It's a subsidiary of S&P Global that determines the components of the index. It has little patience for slackers. And here's just some movements. U.S. Steel, a very old company. It was the largest company in the world at some point, but it hasn't turned a profit in a very long time. And when it fell below the 4 billion threshold, it was out of the S&P index. And Martin Marietta Materials, a construction aggregator producer, took the place. So, the Iron Age gave way to the Stone Age, right? Kind of thing. Or the reverse, or however you want to say it. And the S&P 500 most recent rebalancing was announced now 2021, but I'm sure it was rebalanced. It was rebalanced sooner than that, right? Or more, there's a more recent one than that. I'm tipping my hand with my secret notes here, but that's fine. That's okay. And folks, I apologize for how long this is taking to spiral in here for whatever reason. There we go. Okay, these guys didn't change it yet. This thing was, July 20. These guys are behind. They're behind. Okay, so okay, now it's 14.6. Okay, fine. That one they updated. That thing, the rebalancing. Yeah, so it's another rebalancing here with leg. And okay, no, so we talked about Solar Edge. So okay, so that was the Haynes brand. Okay, fine. So, and what's this one? Yeah, Solar Edge, Fact Sheet, Signature Bank. Okay. Yeah. And replaced Leg and Platt, Haynes brand. And it could have been another one. So some of the requirements um, it felt AMD was I had a I don't know if it's this computer, but one of my computers had AMD in there. Maybe this one. It might be this one. But it fell off the index in 2013. It was added back again. Um, but the turnover isn't as it says it's low. Yeah, it's not very high. But also the length of time companies stay is shrinking somehow. Sometimes company buys a company or replaces on the index or spins off a larger chunk of itself. Forest Labs, Beam and Life Technologies purchased by larger companies, and others leave the list when they can no longer reach the market cap requirement. And then it's relegated to a different index from which its replacement was promoted. The mid cap, we saw this thing before. Is there a survivorship bias here? I don't know. Um, yeah, I'm look. We still think of J.C. Penney and Sears and Hanes brand. I just changed t-shirt brands after using Hanes for the longest time. I changed to a couple of Stafford. I like Stafford t-shirts and things of that nature. Um, yeah, and so it's some of the stocks that have been replaced can outperform replacements. Business is dynamic, and companies get new leadership, and people figure out how to run them better and things of that nature. Who keeps track? How does the company get added? Does the S&P 500 include the Nasdaq? What are the 10 biggest components? Can you just invest in the S&P 500? And then we have a lot of bottom line stuff here. Let's look at the bottom line. It says it doesn't convey information that differs dramatically from comparable indices. It's broadly matched by the more exclusive Dow Jones and the more inclusive Russell. It's a happy medium of sorts. It's comprehensive enough to indicate relative strength and weaknesses of larger companies, but not so exhaustive as to include too much noise with the signal. The overall S&P is the index of indices, analysts, policymakers, ordinary market participants alike. Okay, and then there's a couple questions here. I think we've answered a lot of these. There's index funds and exchange traded funds that allow you to mirror what's going on in the S&P 500. The 10 biggest stocks, we're going to get back to this in a second. Yeah, and the exchanges that the components are traded on. Again, the capitalization, and this is 14.6 now, right? This is 14.6. Be liquid, have a public float of 10% of its shares outstanding, which means the public can trade those shares. The company also must be profitable in most recent quarters' earnings, and the sum of the trailing 4 quarters must be positive. So there's a lot of those accounting conditions there. The Dow Jones or subsidiary of S&P Global. Okay. And I think it's the Russell does the formula and the S&P does the committee makes a determination. Survivorship bias certainly if you've been around a while, right? People are tending to continue to use different companies. But hey, let's hit some of these now. Let's look at Microsoft. Look at the annual reports here. Annual report there. Whoops. So we're cleaning this up a little bit. And there's the Federal Reserve, which is right there. This was the calendar, the open market calendar. That we don't need right now, so I'm shutting that down. So I'm trying to clear out a bit here. Okay. We don't need tax guides. We don't need a tax guide. Don't worry about that. Okay, so what's next? And the listing of these things might be sitting here too. I don't see Microsoft in there yet, but we should. Microsoft. Yeah, 248.59. And the cap is 1.855 trillion. Oops. 1.8885 trillion. And again, so the shares would be about 7 billion shares. And again, I'm not going to check every single one of them, but let's just do Microsoft report. See, I just entered these. And again, to compute this, you took the capitalization times 1,000, right? This 1.85 times 1,000, and then divided by the dollars, and it gave you a value in billions. All right, all this stuff. What I should have done was into the SEC filings. Yeah, look at the previous annual form here. And notice that they just have I said this in class, they just have Word here, which is interesting. They don't use PDF on their website at all. Yeah, 7.5 billion. Yeah, 7.4. We have 7.5. What do we have? 7.457. Yeah. Okay, there. So yeah, we're on target with it. We're doing pretty well with this. Amazon, I saw it sitting here somewhere. There's Amazon, which is right there. So from the last time I did this, right? This is 90.73. No, share price 90.73, which is right there. And the cap here is, well, this is already billions, but we'll do 0.929738. Yeah. It's already your units, right? It's generally in trillions, right? 100, 100,000, 100. So you want this to be these are these are trillions. Yeah, so this not 29 billion, but 0.92 trillion, and then multiply by 1,000, right? And then you get about a 10, whatever the 10 billion market cap on this or so. No, 10 billion shares. 10 billion. Right. These are right in 10 billion shares. So again, this will be the last one that we're going to check. Oh, I did Apple, folks. I apologize. I apologize. I did Apple by accident. Yeah, here we are. And the shares 500 voting stock. Okay, so how do they list it here? Numbers just comes outstanding January 500 million. Okay, that's Amazon. So the share price was 90. The cap in trillions is 0.929738 billion. All right, or 929 billion. Multiply that by 1,000. So we have 10 billion shares there. But this was, but and this when was this out? This came out a year ago, more than a year ago. So that there could be a whole lot more shares issued on this, right? A lot more shares issued. This is coming as 10 billion. Okay, and this is 508 million, 100,000. Yeah, 500. So this is half a billion common stock outstanding. So there's a half a billion. So there could have been some sort of and what year is this? This is okay, 2022. Okay, and let's see. Let's go back. We don't want all types. Like I said, there could have been an event where they had a big buyback or a big issuance or something, like that. So that could have happened. Why those numbers are so different from a year ago. Let's check out what we have here. Again, folks, apologies for how long the boot up is taking here. So no, it's the same. Okay, 508. So this is the value. So this is in dollars, 100, 1,000, 100 million, 1.5 trillion, right? 1.5 trillion. Yeah, about a trillion, right? 929, it's about a trillion. Okay. It's about a trillion. And usually they give a stock price too, but they kind of made you compute it somehow. Yeah, this is common share. There might be some other set of shares. Hey, we're not going to go bananas with that. We can dive into that at another time. Let's look at Tesla. Like I said, I'm saying for that much of a difference, you're gonna have, you want to account for that. Here's Tesla. Okay, the capitalization is 0.548782. Share price would be 173.44. So the shares outstanding would be about 3 billion shares outstanding. And then there's different class. Amazon, I'm sure, did some sophisticated classes of shares, version of things. So that the share use just makes it so complicated to not. I'm saying you have to deal with that, but the companies that we deal with are generally privately held with a few shareholders, and you don't have that. Okay, but we have various classes of shares. You talk to the attorneys, talk to people who worked on that, and figure out why it is what it is, kind of a thing. So Tesla, so a billion shares of Tesla, and here we have three. So this is a year ago, and again, there could be other. Yeah, they gave the market value 541, 548, 541. So we're okay with that. Okay, the market value is matching up, but just the number of shares, there could be Yeah, it's common stock outstanding, and there's other people holding these. And again, how much the public has access to outside of sort of the insiders, that could be a different number. Okay. All right, like I said, I'm not going to go bananas over that. Let's just keep doing this. And see, Google has Class A, Class C, right? There's a couple versions of this. Now, did I do the same for the Googles in the past? What did I do in the past with this? Meta Alphabet here. Yeah, did I do the same ones for those? I don't know how I did that, but okay. Yeah, now the share price is 91 somehow. No. Yeah, this is Google with an L. Yeah, here we go. This is Google with an L here. Whoops. I didn't want that. There we go. So these were yeah, this is Google with an L. And instead of 2000, now it's 90.63. And again, you're gonna have to dig into why, and the market cap is 1.163 trillion. Okay, so again, these shares, there should be 12 billion of these sitting around. Okay, you have that one. And this other version, Goog, without the L. Without the L. Right there. This is 90. So again, so there's some kind of restructuring that sort of happened here. And the cap is the same cap. And again, you're gonna have to dig in and the shares and all those other kinds of things. NVDA is next. NVDA. $6.5, and the capitalization is 0.572. And this might be the last, hopefully this one will, so we'll do NVIDIA. Hopefully this one, they didn't go as bananas with this. And then all the different classes and because there's a lot of founders and people who invested probably had a big payday. The people invested in Google. That's why you have those classes of shares. If they weren't that valuable, it wouldn't be, people wouldn't be breaking up saying, hey, you came later and you're not going to get as much as me, kind of a thing. Again, folks, apologies, the computer a little hung up here. So there we go. I think I had too many. I need to realize too many tabs open tonight on the browser. There we go. Forms, annual filings. Look at the view. Yeah, see now they're popping up a little easier. So we're doing the common stock was 2.4. Yeah, these guys are doing it the old way, where they're just the common shares outstanding, and oh, you know, they do get the aggregate 434, 572. Yeah, 247 billion, 249 billion. Okay, so see, that's how it's like I said, some of the other ones have a little more complexity with the way they structure everything. Now we have Meta here. So let's look at the Facebook thing. So they have their shares are about you can see the number should be similar to 2 billion or so, 2.5, just like Nvidia. Okay, the cap is about 465 billion. So in trillions, it's about a half a trillion. Okay, Berkshire. Let's see how again Buffett. God knows what he did here. There's different classes. Okay, no, that should be it. Yeah, Buffett's, and I think he's never. They never did a split, or so this is point. Whoops, 0.6712. Again, he should have about 2 billion shares. Again, the value of he's about a little more than about half a trillion. But what you should notice is the Apple, the Microsoft, the Amazon, the Google. Those are the trillion-dollar companies. And Tesla's up there, Nvidia, but the Berkshire and JP Morgan fell out of the top 10. I think United Health might be in there. We're gonna just keep with the JP Morgan for the time being. JP Morgan, yeah. So these guys, their stock price is about the same from a year ago, and their value is about the same 3,393,380. Again, so they should have about 2. And here, just for the hell of it, let's we've been looking at a couple of them. TM annual report. So they would need about 2.9 billion at JP Morgan with the shares outstanding. So I guess so you saw some sense of the whole capitalization competition, and also some of the problems you're gonna have to sort through is when things don't add up, you have to chase down why. That definitely is. Yeah, 2.9, yeah, almost exactly. 2.943, 2.943. Yeah, the JP Morgan one was gonna be pretty straightforward. All right, through 27, 393 billion market capitalization. Okay. I'm looking up here. All right. All right. So there you go. So you had some experience with this, and we're still not done. So hopefully, if you want to take a break, you can take a break, I suppose. But we're going to keep going here. So we did the capitalization computations, the share price, did the percentage changes in the indices, and now what we're going to do is and you could save this as you go. Make sure you're saving your work as you go. Now we're going to go to the St. Louis Fed, and I think we did this already at the beginning of the discussion here. There's two of them right next to each other somehow, which is bad. January 1. Yeah, this one, let's get rid of this one. See, now it works a little bit easier. I had too many tabs open. The Wall Street Journal and the weather. Never leave the weather tab open on your computer. So yeah, we set this as to January 1st, 2018 up to Friday, 310. So you're going to download this into Excel. This is from the Federal Reserve website. And again, now you're gonna now it's funny. I complained so much about the setup, the rig at in the classrooms with my rig here, the computer setup. The downloads seem to take some time, but it's St. Peter somehow they go pretty quickly for some reason. I don't know why. This is the last thing, and we'll look at the volatility here a bit, and we'll do some and you have all these readings. You have all the readings in the Excel. You have all the readings. So yes, most of the readings are in Word, but in the PDF. But this one, just read them in the Excel file. It's the same thing. You guys, you'll be okay with that. Now, you guys are, bear with me a bit here. We're gonna have to go through this, and if you guys don't mind, I don't know why it's fighting with me to move here, but enable editing. Yeah, don't worry if you really can't see this that great. That doesn't really matter right now. A little bigger so I can see it. See all these NAs. There's a way to do it. There's a way to we're clearing these out, and what we'll do is I'll keep hitting control, but these are Christmases and New Year's, so there's a few of them in here. There's a way to do it sort of a different way that I'm doing it now. Somebody showed me a long time ago. I forgot how it happened. It was a real complicated way to do it. But you kind of got rid of everything. See here, I missed one. Now I got to go back and sort of fix these. So if you miss one, it screws up all your I kept hitting control. See, like this one, click there, this, click there. You're getting rid of all the Christmases and the New Year's and all those kinds of things. Delete. No, I didn't want to insert. Control Z. There's probably a better way, and I'm sorry. I'm sorry if there's if I'm insulting anybody by doing it. It is very sort of a rudimentary way of doing it. There might be some excellent Excel folks out there, but I'm a scientist and I use Excel to the point that I needed to use it. But I'm about what I'm saying, not so much about the latest inventive way to do something in Excel like this. We analyze data. I use mathematics to analyze data. I don't use Excel functions or gimmicks to analyze data. So, but folks, just be patient while we but again, this is a part of, these kinds of things. This is a part of sort of what you're doing here. Because you'll have these funny drops in the graphs if you don't get rid of these. Now, I don't know why the Fed, maybe their computer systems are so old. I don't know why the Federal Reserve, sort of were reduced to doing this. I don't really know why, but well, it's the day after 4th of July. This is Labor Day in 2021, right? So we'll get rid of it. And then we're gonna have a couple holidays coming up here. This might be Thanksgiving. There's Christmas or Christmas Eve rather. We're almost through them all. like I said, I'm sure there's probably some, especially in the graduate section. If you guys want to drop me an email as to how to do this better, I'm happy to entertain it. One time, someone at Rutgers or somewhere, NJIT maybe or whatever it was, there was a statistical move with the stem and plot graphs, and somebody emailed me something that I probably could have found it eventually, but someone sent me an email. I remember it was good. It was a set of instructions. I was very impressed with it. I forgot who it was, but so there you go. Okay, so this is um, up to March 10th from yesterday, from January the 2nd of 2018. You're going to right click, you're going to copy the data, and all this other stuff. I've already brought it over for you guys, the titles and all these things, but you've got to and see what's this, the observation date. You may want to go one below it. You want to just bring the numbers in, because it's already formatted for you. Okay, and this, the date's usually a smaller a smaller sample size. The date's usually a smaller sample size to things. Okay, this is just that top line. I'm going to get rid of that. And yeah, there's a bunch of these borders here, and I have to fix them. We'll do a few. I'm not going to go through 5 years of borders, but I'll show you a couple, just sort of how to sort through what's going on here. But oh, and there's more years here too. So you're going to do more border, or get rid of that. So no border. And also, I just, because now we have maybe a little more data than we were set up for. So now what you have to do here, you're going to say copy. You're going to do paste formatting. There we go. Okay, see? And you brought the formatting all the way to March, whatever it was. And then from here, there's other stuff you're going to have to do. Okay, so, and again, use the page up, don't use the wheel on the mouse, use the page up. And especially, and you're going to see this is probably, a good 1,000 pieces of data or something to that effect. And also what you want to do, since you're here working like this, yeah, this is italics, and the font is a little bit smaller. You're going to say equal +1, clear this out, and say just all the way down. Well, without blowing past it. Control D. So yeah, you have 1,300 pieces of data. So that you're dealing with here. Okay, and you want to at least the years. You want to break up the years. So yeah, so the index change. So let's clear out some space here. The index change is just simply what you're just gonna whatever that change is. So change by 17. It's 17 more. The percentage is that delta divided by the initial reading, so about 0.5%. So what you'll do is Control D. Right, you're there with that. So now, this is the volatility measure without indices and things of that nature. We're going to graph. What are we going to graph? We could graph the behavior of the index. I think that's how I did. I think I graphed, but now for the graduate folks, you're probably pretty good at making graphs. So, but we're going to go through. The younger kids need it, so we're gonna go through that. Sorry, guys, just getting some wires out of the way here. We have a lot of USB ports. So what you're going to do once you've got all these, you're going to just select. This is just a delta. It's just a change. It's a difference is all it is. You're higher or lower than the previous day, and this is the percentage change. So you're holding the shift. You're going to page all the way down to March 10th and say Control D. Okay, you see you have the -0.5 of the percentage, and unfortunately, what I think what we determined was you had more volatility recently than I don't want to say hey during the Trump years, but maybe during the Trump years kind of a thing. So what I'm doing is every month now you can go bonkers doing this, but every month I'm going to sort of put a border, and actually with these, you want to get rid of all this. Right, clear out the fill, and also here, let's go to the top up here. This is the Federal Reserve economic data, the link, the research, economic research division. These are S&P 500 readings. It's a daily close. It's a index. It's not in dollars. It's an index. Okay, keep that in mind. Okay, and these are the index changes. So what you're going to do is you're going to want every month. Right, you could say something like this too. You could say Alt H, bottom border, right, like that. You could just use the buttons to do it. But like I said, it's a tedious process. Right, bottom border. And if you lose your place or something, what month you're talking about. So, like I said, we're not going to do the whole. You're seeing what I'm doing here. So now, what you're going to want to do, and let's look recently at like maybe the last year. We could just just throw a quick graph up there. And what it'll do is you'll memorize the keystrokes, right? Alt H B Z, the letter O. Okay, so we did it for all of 2022. All right, we sort of put borders in. All right, so now what? So we're going to say copy. Actually, what you really need is equals average parenthesis. You want to do the average delta for that month, right? You want to center it, number percentage to, okay. And then with the other thing here, equals average, all these deltas. These are the index changes. I'm going to center these guys. That's just a number. Okay, and now what you can do once you have these, you can just go in your mind's eye without having to stop and say, oh, where am I? Where am I? You can sort of put these, drop these all. And what you're going to see, unfortunately, is that as you go deeper into the year, it's going to be the percentage change, 0.44, 0.49 compared to the earlier parts of the year when these numbers were these average 0.30. These numbers were a bit lower, 0.29. 0.31. Let's see the February one. Yeah, the February one is not that bad, but still, yeah, you had some. So February it didn't. But you're going to see this bigger numbers of this. You can graph these the volatility numbers here, but that's how you measure your volatility. That's your average change for the month. The average percentage change for the month. That's your volatility. And what you can do for something like this, you could do just a fast graph of this. Something like that. See? Maybe do that. This thing, legend top. Okay, so, and you can see when you have a lot more. Actually, we might keep this graph. I don't know if the line is the best version to graph all these points here. And what you could put them in bins and obviously you can see and you can see, I hate to say it, but during the Trump years, it was less volatile. It's certainly been more volatile the last 2 years. It's just what it is, right? But obviously this is COVID. Obviously right there is COVID. And what you want to do is, you want to click on the series, and you can see you can see what numbers it's representing, these average percentage changes. And what you're going to want to do is you're going to want to go to select the data, edit. The X's are way up here somewhere. So I think you're here with this, and say shift control down. There you go. Okay, and daily percentage change without spelling errors. Okay, you have the dates in there. And you could do, you could do some maneuvering with this. This is S&P 500 daily percentage change. Previous day. All right, and this could be a little smaller if you want. Okay, you can put a border around this thing. A nice gray border up there. Oops, that's fine. Okay, and you don't need to go into July 2024 because you don't have that data. So you're going to format this access, and I don't know. We could do, yeah. You're into, yeah, just March 23rd. I think it's like that's like the number of days or something like that. And this thing is, I don't want this. No. Yeah, there you go. That's a little bit better. All right. Yeah, that's okay with that. And this thing, format axis, you could go there. Okay. And with this thing, which is major unit, you're going 500 days. You could do 100 days maybe. All right. And then you can flip these things, which is alignment. You can do -75, something like that. Okay. And the font, you can make those a 9 or something smaller. Okay. But there you go. All right. And you could put a border around this, an outside border around that. I don't know, with this 15, I don't know how we need that. So this thing can go to 10. And this thing can go to maybe 3 or something like that. All right, that might be a little bit better. Format the axis. Yeah, you can leave it like that. And the grid line here, you could, with the grid lines, you could do a fill, a very light fill. And plot the area shadow right there, do a shadow. And grid lines, no line. How's that? That looks good. Days. Percentage. Okay. And we could do that. This is what we could, this is the volatility. We could graph this other thing here. I think a lot of you could probably handle that, right? Without too many problems. So here, since this was, so yeah, that's the percentage change. I can do another, I can say copy. I can paste that in there. We can click on the data. We can roll over here and just go to that and make it bigger and make this bigger. Yeah, that's the behavior of the index. And this thing, just go back to automatic. Like that, and at least you'll get the the readings here. They're not, these are no longer percentages. This is the index value. Okay, it's the index value. We don't need from previous day. This is daily value, which is right there. Allison, minimum major unit 250. $300 seems to work a little bit better. Even that is a little crowded. 400, a little bit better. Yeah, something like that. Okay, again, you have a lot of data. 1,300 pieces of data here. And daily percentage change. And identify this. This is daily value. Okay. Maybe index daily value. Something like that. And you could change colors and the outline. You could do all that. But there you go. So you have how volatile. Obviously, you could just from by looking at it, you could see you have a little more volatility here than you've had. This is obviously before the pandemic. Obviously, the pandemic was right there, and then since then, and we had a little bit of a calm down a couple falls ago, but not much. This was very, the Trump years here, these were very good. And even if you go back to, I think, 17, you'll see it's pretty good. Okay. Again, I'm not espousing for any one candidate or another. I'm just saying that. So, okay. So you saw how to find the data here. And like I said, so you could go through and every month, chop these off. Like I said, I'm not going to do 5 years of just repeating myself here. Okay. So you guys can go this thing here. This percentage is just the average percentage change. Oh, and also something to keep in mind, these the months may not be the same. So you want to go through every one and just make sure. Yeah, see this one spilled over a bit. You got to be careful with that. Some of them might be too, this is too small. So you got to go through. So again, it's tedious. It's you're sitting there. So maybe want to put on, whatever, the Grateful Dead or something. Or whatever. You guys, most of you guys don't even know who that is. That's the San Francisco band from like the 70s and the 80s or whatever it was, the 60s or something. You guys, Jerry Garcia, the ice cream is named, the Vermont ice cream is named after that dude, right? See, listen, you're missing 3 of them here. Okay, so you have to go through and fix a lot of things. There's probably a way to program this to do it like this. But I haven't really sat down to do it, but it says if whatever, if you're missing something or I'm sure some logical routine will help you do this. Okay, and then save for work. So there we go. So we had 3 sets of notes on Standard & Poor's 500. We did a little we did a little market capitalization computations, and again, I sort of went through these notes a bit, but you guys can go through them a little bit better on your own. The requirements for being a part of the S&P 500, and how to look up some of the latest criteria, right? To market capitalization eligibility criteria that's just published by S&P and Dow Jones itself, and how to find some of the readings, from a federal, the Federal Reserve Bank site, how to make a couple of these graphs. Okay, so we did a lot of good. So we did it in one lecture. I know this might be a little, this 2 hours might have been a little long for you guys. I know that, but the day, what this looks like, it's dipping a bit now compared to maybe the end of October 2021, when we had this was the Joe Biden euphoria, and it's become rocky, right? It's become, just to be blunt about it, obviously that's a lot of volatility there, and you can see the thicker that is right there, the more volatile it is. Folks, thank you very much. Okay, so I think we're good here. Get rid of this thing. Okay, we're here. We'll do the stop share. Okay, folks, thank you very much, and we'll see you soon.